to find out the covariance. So I think we want that discussion, how to calculate the covariance, and also I explain what is covariance. So covariance you can calculate using this both formula. If you know the standard deviation of X, standard deviation of stock Y, and the correlation coefficient of two stocks, then you can use this formula to calculate the covariance. Otherwise, initially, in order to determine the covariance, you have to use this one. So by applying this second formula, I think we remember that we calculated the covariance in our example. So just recap the example, right? So we are continuing on the same example. So in this example, you remember that there were two stocks, X and Y. Expected return X was 4.68%, Y 3.42%. Standard deviation X 4.51%, Y 4.67. So likewise, you remember that. So this is our example, two asset case. So now we are constructing a portfolio equally investing on X and Y. So we calculated portfolio expected return. And also we calculated covariance of two stocks returns was minus 10.73. So the covariance is minus. It means that they are moving to the opposite direction in a particular time. So they are moving to the opposite direction, right? So because that is negative, when X stocks returns are increasing, that Y stocks returns are decreasing. So because that is negative relationship. So by looking at the covariance, you can identify the direction of the movement only. You can identify the direction. But exactly by looking at the covariance, you can't say the strength of the relationship. In order to identify the strength of the relationship, you have to calculate correlation coefficient. So today we are starting on that point. So I think we done this also. Applying the covariance here, we have calculated again portfolio risk using the double summation equation. It was 2.28. Now in this double summation equation, this covariance you can replace using this part, right? Covariance is equal, covariance 1 and 2 or two stocks is equal correlation coefficient, two stocks returns, standard deviation 1, standard deviation 2 for X and Y. So therefore, now you can see I have expanded the double summation equation using this part. Nothing difficult, right? So now correlation and coefficient, correlation and covariance, both we are using to measure the co-movements of two stocks returns. But like in the variance and standard deviation, this correlation coefficient is better. I think you could remember that variance and standard deviation, both we are using to measure the risk. But rather looking at the variance, just looking at the standard deviation, you can interpret the risk very easily than the variance. Because I explained it, that variance is a value. But when it's come to the stock returns, this standard deviation always is a percentage. So therefore, interpretation part is very easy by taking the standard deviation. Similarly, here, covariance and correlation, both we can use to measure the co-movement, but the use of the correlation coefficient is better, because that interpretation of the co-movement is easy, and also identification of the co-movements of the two stocks returns is easy by looking at the correlation coefficient. So now we are going to calculate the correlation coefficient for these two stocks in our example. Again, if you look at this bullet, you can see what is the difference between the covariance and the correlation coefficient. Covariance just give the direction of the relationship, direction of the co-movement. But this correlation coefficient gives you direction as well as strength. Direction as well as strength of their co-movement. So correlation coefficient you can calculate, right? You can see by using this formula, you can derive a formula for the correlation coefficient. So correlation coefficient is equal covariance of two stocks returns, I and J, they are the two stocks here, divided by standard deviation I, standard deviation J. So now in our example, we have calculated covariance and also standard deviation X and standard deviation Y. So now you can calculate correlation coefficient. If you calculate correlation coefficient, you will get the answer. But before that, you know how to interpret the numbers. When it's come to the correlation coefficient, that correlation coefficient value is lie between this limit -1 to +1. It's going or it's moving from -1 to +1 via the 0. So then correlation coefficient cannot be 1.5. Correlation coefficient cannot be 1.5 because it is beyond this margin, beyond this limit. So correlation coefficient can be a number in between -1 to +1. So when the correlation coefficient is -1, we call that perfectly negative correlation coefficient. So it means that two stocks returns are perfectly negative. So once say X and Y, X stock returns is increasing by 10%, Y stocks returns is decreasing by same amount by 10% if correlation coefficient is negative. If correlation coefficient is positive, that is perfectly positive. When one stock returns is increasing by say 10%, the other stock returns also increasing by 10% because a perfectly positive correlation. But anyway, these two N are very extreme. Normally in the practical world, if you go to the market, if you calculate the correlation coefficients of two stocks or around stocks, so you would see that it's very rare to have perfectly negative correlation as well as perfectly positive correlation as well as zero correlation. So practically they are very rare cases. So normally correlation coefficient lie between this -1 to 0. It can be say a -0.58. This is a possible number. And also it can be say 0.7 or 0.75. So these numbers are possible as well as very probable when you calculate the correlation coefficient for the two stocks. Now, if you take this one, correlation coefficient is -0.58. What is mean? -0.58. So it means that their co-movements is negative because this is minus now. But it's not perfectly negative. When one stock returns is increasing by 1%, other stock returns is decreasing by 0.58%. So that is the strength of the correlation coefficient, because by looking at this correlation coefficient, you can identify the direction of movement as well as the strength of the movement by looking at this number. So when X stock returns increasing by say 1%, Y is decreasing less than 1. So that is 0.58. If it is 0.75, is a positive, movement is positive. Say X is increasing by, when X is increasing by 1%, B is increasing not at 1%, but less than 1, that is around 0.75, because it is a 0.75 is the correlation coefficient, not perfectly positive. So likewise, the interpretation of the correlation coefficient is very easy. If it is 0, what does mean that? 0 mean no correlation. No correlation. You can't interpret. When X stock returns is increasing, you can't say exactly what's happened to the zero. It can decrease, it can be increased, so that there is no relationship. The relationship is null. If correlation coefficient is zero, the relationship is null. So you cannot say what happens when one is increased to the others. It can be decrease or increase or whatever things. So likewise, the interpretation is correlation coefficient is easy than the covariance, because by looking at the correlation coefficient, you can identify the direction of the movement as well as the strength of the relationship. Now, you can calculate correlation coefficient for our example. So I explained this thing. I think no need to repeat this slide. I actually already explained. Right? You can read it later. So if you calculate correlation coefficient for our case, in our example, now you can see it is minus 0.51. I have given the answer, so you can just use the calculator and check whether you are getting this number. So our covariance was minus 10.73. Standard deviation X. This is standard deviation X. This is standard deviation Y. So you will get the perfectly, that is not perfectly negative. The correlation coefficient is less than 1. So that is minus 0.51. So again, you can apply this correlation coefficient now to the double summation equation. Simply you can see you are getting the same answer. Now you, instead of the covariance, you are applying this part for the double summation equation. So correlation is minus 0.51, standard deviation X, standard deviation Y. Other all are same. So you'll get the same answer, no difference. You will get 2.28 as the portfolio risk. So this is what the correlation coefficient. So now I think you are very clear about this calculation. So the ultimate purpose of constructing a portfolio to minimize the risk. Rather than investing in individual stocks, you are constructing a portfolio because you want to minimize risk and you want to maximize return. You want to get some maximized return at a reasonable level of risk. So now in here, if you invested X only, your expected return was 4.68. If you invested Y only, if your total wealth you invested on Y, your expected return was 3.42. And also you have already calculated this risk of this expected return, stock X 4.51, risk of Y 4.67. Once you compile or once you construct a portfolio using the X and Y, no, one of you have asking some question in the chat box. He's asking that when the correlation coefficient is 0, does it mean that increasing by 1 for others returns? No. Other stock also return. Actually, we can't say that. When it is 0, the relationship is null. When the one stock returns is increasing, other stock returns are also changing. It is returns is changing, but you can't say whether it is changing to the positively or it is negatively, or sometimes it can be remain at the constant also, because that there is no relationship between X and Y. That is the meaning of the correlation coefficient is 0. The null means there is no relationship. So therefore, you can't say when the X stock returns is increasing, what happens to the Y? It can increase, it can be decreased, or it can remain constant. That is the meaning. Right? So once you construct the portfolio, you so that your portfolio expected return is 4.05. Your portfolio risk is 2.28. Now you want to check whether you have received diversification effect or whether you have get a diversification impact. So because our ultimate aim of constructing portfolio to diversify the risk. Now, if you invested only X, your risk is 4.51. If you invested only Y, your risk is 4.67. Once you construct portfolio using X and Y, your portfolio risk is 2.28. Right? So now I will explain how would see that whether you have gained some diversification effect or not. So that's what we are going to discuss next. Now, if you calculate the weighted average standard deviation of these two stocks, right, you will get 4.59. Right? Weighted average standard deviation mean 50% from the X stock standard deviation, 50% from the Y stock standard deviation. So that is we call weighted average standard deviation. Here you can see a portfolio return is a weighted average expected returns of the individual stocks. This is weighted average. Remember that we calculate the portfolio expected return of considering weighted average expected returns of the individual stocks. But see what that when it's come to the portfolio risk, if you calculate the weighted average standard deviation, it is 4.59. 50 from 4.51, 50% from 4.67. Actually, one of asking that how you get the 0.5. 0.5 actually our weights. If you go to the question, I ask you to come with the good memories of the previous week discussion.
Okay, madam. If you are continuing the same question, no issue. We can
we are continuing the same question, right? Still we are on the same question.
Okay, madam.
So that is equally weighted now 50-50. After calculating correlation, can we identify exactly which stocks either X or Y is increasing, or just give the normally now we are pronouncing that two stocks at the X and Y. So when we interpret in the correlation coefficient, we normally interpret when X is the what we call that priority one. So we define it as when X stocks is returned, because these two stocks return covariance can be for the either side. දැන් covariance එකෙන් අපි බලන්නේ දෙන්නගේ movement එකේ direction එක x වල ඉඳන් y වලටත් එකයි y වල ඉඳන් y වල ඉඳන් x වලටත් එකයි. So you can start with either stock, either x or either y. But normally I am interpreting because we normally pronounce that x and y no, a and b no. So therefore I explained it when the x is increasing this much, this happened to the y. And also same thing happened when the y is increasing, because the covariance mean either x from to y, that covariance is -10, or y to x covariance is -10. So therefore you can pick either x or y when you are interpreting. Nothing that is nothing any theory here. Right. So now here when you calculate the weighted average standard deviation, the number is 4.59, but our actual portfolio risk is 2.28. This is actually based on the covariance of these two stocks returns. If you construct a portfolio using X and Y, your real actual portfolio risk is 2.28. But if you just calculate the weighted average standard deviation, it is 4.59. So that is greater than, or this portfolio risk is less than the weighted average standard deviation. Now, if you read this slide very carefully, therefore, the standard deviation of portfolio returns is dependent on the correlation and covariance structure of the stock. So now here you can see portfolio risk really is 2.28. This depends on the correlation covariance have between the X and Y. So this is not simply the weighted average standard deviation. නමුත් අපි portfolio එකේ expected return එක ගන්නකොට ඒක weighted average එක. ඒක correlation එක මතවත් මේ covariance එක මතවත් වෙනස් වෙන්නේ නැහැ. That is weighted average. portfolio එකේ stocks 10ක් තියෙනවා නම් 10ෙම weighted average එක තමයි portfolio එකේ expected return එක කියලා කියන්නේ. But when it's come to the risk, it's not the weighted average. Because this number, this portfolio risk is depends on the covariance and correlation structure of the two stocks returns. A stocks වල returns අතර තියෙන සහ විචලතාවය සහ සම්බන්ධතාවය මත මේ risk එක රඳා පවතිනවා. So now we are moving to the relevant risk, right? So therefore now if you calculate the weighted average one, that is 4.59. So therefore, the standard deviation of the portfolio return is dependent on the correlation or covariance structure of the stocks in the portfolio. When the correlation of two stocks is 1, right? When the correlation of two stocks is 1, that is perfectly positive. The standard deviation of the portfolio is the weighted average of standard deviation of the stocks. If correlation between two stocks return is 1, perfectly positive, right? Correlation perfectly positive when X is increasing by 10%, other also increasing by 10%. So that is perfect. At that time, if you calculate the portfolio standard deviation, it is equal to the weighted average of standard deviation of the stocks. Right? When the correlation of two stocks is less than 1, when the correlation is less than 1, the standard deviation of the portfolio is less than the weighted average of standard deviation of the stock. When the correlation less than 1, right? When the correlation less than 1, portfolio risk is less than the weighted average standard deviation. Since the correlation of stocks are in general less than 1, right? Since the correlation of two stocks are in general less than 1, the standard deviation of the portfolio is less than the weighted average of standard deviation of the stocks. This effect we call diversification advantage. So this is what the diversification, right? So normally you know that correlations lie between -1 to +1. So if it is +1, actually no diversification impact. Correlation coefficient is +1, perfectly positive, no diversification effect. Simply portfolio risk is equal to the weighted average standard deviation. Right? But normally, I told you that normally correlation coefficients are normally it's beyond the +1. It's somewhere in the here. It's not extreme side, -1 or the +1. -1 is okay, perfect. So then totally you can diversify the risk. If the correlation coefficient is -1, perfectly negative. But normally correlation coefficients are less than 1. So therefore, portfolio risk is normally less than the weighted average standard deviation value. Now here, if you look at our example, our portfolio risk also is less than the weighted average standard deviation value, because weighted average standard deviation value 4.58. Now, so if you calculate here, now I will explain with the calculation. We'll take the same example, right? I have put the numbers with the same example. So now instead of our real correlation, I have replaced here +1, perfectly positive correlation. Simply you can solve this formula. Only thing I have put here, what instead of this this correlation 0.51 minus 0.51, I have replaced 1. Other all are same. So now calculate the portfolio risk. Simply use the calculator. Instead of -0.51, use the 1 and see what is the correlation. Sorry, what is the risk? Quickly see the number. What is the number coming here? What is the number? Just let me in the chat box. Simply you can substitute the numbers here. This is actually the 0.5 square, right? Not 52. This is 0.5. It's square. This is square. This is covariance. Not covariance, variance of the stock X. This is also a square of the 0.5. This is variance of the Y. Twice 0.5, 0.5. Standard deviation X, standard deviation Y. Now here, instead of our correlation, I have put the 1. Did you get this number? Now your portfolio risk is 4.59. So when the, have you got the 4.59? Anybody please? 4.59. So this is variance actually. This is portfolio variance. So you have to take the square root of that. Then it is the standard deviation. So you would get 4.59. So now you can see this is weighted average standard deviation. So when the perfect positive correlation is there, there is no diversification. Now, if you use the negative one, what is the correlation? What is the correlation is negative one. When the correlation is negative one, what is the standard deviation? So simply what you have to do, you have to substitute here -1. Simply you put here correlation coefficient is -1. So see what is the number? So you would get 0.138 as the portfolio risk, 0.138. Yes, 0.138. So see, risk is 0, almost 0. If you can find the stocks with the perfectly negative correlation, you can minimize risk up to the 0. That possibility is there. If it is 0, if correlation coefficient of 0, that is no correlation between two stocks. If it is 0, even moderate level diversification is possible. Now you can substitute here 0 as the correlation coefficient and see the number that you will get is 3.25. You will get portfolio risk when the correlation coefficient is 0 is 3.25. Right? So you will get this number, you can check it. So now see, even moderate level diversification is there. How do you say that this is moderate level diversification? Because 3.25 is less than the weighted average standard deviation of the stock. Is less than the weighted average standard deviation of the stock, because now here 3.25. So there is a diversification, but not very large, huge diversification, but moderate level diversification is there when the correlation coefficient is 0. So that's why we told that since the correlation of stocks are in general less than 1, the standard deviation of the portfolio is less than the weighted average of standard deviation of the stocks. So this effect we call diversification advantage or diversification effect. So diversification always reduces risk provided the correlation is less than 1. So diversification always reduces risk provided the correlation is less than 1. So then you can guess whether diversification advantage or diversification effect you have gained by constructing this portfolio simply by looking at the weighted average standard deviation. So that is rule of thumb actually. So once in a question, if you ask whether you have gained diversification advantage or effect by constructing this portfolio, so you calculate the portfolio risk and compare this portfolio risk with the weighted average standard deviation. If it is less than the weighted average standard deviation, normally there is a sort of a diversification advantage. So this is what our purpose, this is what our objective of constructing portfolio. So we are constructing portfolio to reduce the risk. So now I think you clear that risk is depend on correlation and covariance structure. It is not the weighted average standard deviation. එතකොට අපි portfolio එකක් හදපුවාම portfolio එකේ risk එක අර expected return එක වගේ weighted average වෙන්නේ නැහැ. ඒක depend වෙනවා stocks අතර තියෙන සහ විචලතාවය සහ සහසම්බන්ධතාවය මත. So that is the important message or important point for to next discussion. That is we call we are going to identify the relevant risk. Even though we using the standard deviation, you are measuring total risk. But in few minutes you will learn that total risk is include systematic and unsystematic risk. By constructing portfolio, this unsystematic part you can diversify away, but this systematic risk remain undiversified even you construct well diversified portfolio. So that's our next discussion. So I think up to this point you are very clear. And also now again I think further elaborations are there. So this is the diversification limit when correlation coefficient is positive 1. In Excel you can practice this. Use these two stocks X and Y. You are given their expected return and also standard deviation. If you construct portfolio by changing the weight, say here 50-50. So you can take another number, find 60-40, 10% to 90, so for say 30 to 70. So likewise, changing the weights, if you construct this this line, if you draw the expected return and standard deviation, you will end up with a straight line like this, if the correlation coefficient is perfectly positive. So your diversification effect limits from here to here. This is actually, now if you draw the line here for the, this is for here, this is actually the risk of stock X, that is around it is around 3.5. No, stock X is 5.2. This is stock Y risk, that is around say 3.5. So the beyond this 3.5 you can't reduce the risk. Once you construct this portfolio, when there is a correlation perfectly positive, though you construct a portfolio by changing these weights to the different proportions, you will end up with a line like this. So no diversification impact. Only the risk is a straight line. It is it's not increasing more than 5.2, and also it's not decreasing less than 3.5. So this is the limit of diversification when correlation coefficient is perfectly positive. In Excel, you can draw this. And also when the correlation coefficient is 0, when correlation coefficient is 0, this is the path. This is the path. So you can see this is actually the X stocks standard deviation. This is Y standard deviation. Now, when the correlation coefficient is 0, you could see that there is a certain level diversification, because you can see portfolio risk is decreasing to up to this point. So this is less than the Y stocks standard deviation, And also, if you invested only X, it's standard deviation. So there is a certain level diversification, but it's never reached to zero. It's never reached up to the zero, but certain level diversification is there. Risk is minimizing, risk is decreasing like this. It's come to up to somewhere in 2.6. This is not 2.6. This is 3.5, 3.5 something. This number, no, it's some, this is 3.35. This is 3.35. So you can expand this, right? By changing the different weights, you can draw this line. So this line looks like this. So the X stock deviation or standard deviation is decreasing. Why standard deviation also decreasing, but to a certain level. So this is what happens when the correlation of two stocks returns is zero. When correlation is perfectly negative, what could see? So now you can see there is a one point where standard deviation is zero. Now here, this is the X stocks X standard deviation. This is the Y standard deviation. So X standard deviation is decreasing. Y standard deviation also decreasing. This is portfolio standard deviation. So portfolio standard deviation is moving in a line like this. There is one point where portfolio risk is equal to zero. If you invested 40-60 weight, if you invested in 40-60 weight on X and Y, you would see there is a point where expected return is equal to 3.8. Portfolio risk is equal to 0. So total diversification is possible. Total diversification is possible if you can find stocks where the correlation coefficient is perfectly negative. But in practical world, that's very rare. You can't find. But anyway, if you can find, then there is a possibility to diversify the totally that risk to the zero. So now if you draw all these lines in a one, so that is the shape. Since any probable correlation of securities will range from -1 to +1, the triangular in the above figure specify the limits of diversification. So this is around when the correlation coefficient is 1. This is where correlation coefficient is 0. This is when correlation coefficient is negative. The risk return curves for any correlations within the limits of -1 to +1 will fall within this triangular. So if you use two stocks and if you construct the portfolio with the different correlation structures, so you will end up all the numbers, all the portfolio risk and standard deviation numbers will fall within this triangular or within this diversification limit. So this is with the two stocks. This is with the two stocks. But when it's come to the right, so this is further elaboration of the same thing. You can see that you can draw different lines. අපි විවිධ stocks දෙකක් එකතු කරලා විවිධ correlations යටතේ මේ structure එක ඇන්දොත් මේ triangular එක ඇතුලේ මේ ඔක්කොම lines වැටෙනවා. මේ correlation එක -0.25 -1. So likewise you can check even with the data. You can check this. You can calculate and you can draw this line and you will see the shape. Now, right. So before going to the next one, actually. I would, now this is actually the homework, right? I am not going to do this now. Now there is another example, right? You can see two stocks here. Sorry, three stocks are there. ABC. This MP is the market portfolio. Treasury bill, TB rate. Market portfolio is the, you know that there is a kind of a market portfolio that reflect all risky assets. In Sri Lanka, that is the Colombo Stock Exchange. All share price index reflect the market return. So this is related to the market portfolio. Now here, expect a return and standard deviation of the portfolio of 60% stock A, 40% stock C. If you construct a portfolio investing on stock A, 60% of your wealth, and also stock C, 40% of your wealth. So now you have to construct a portfolio, because based on the discussion we conducted up to now, you can do that. This is a practicing question. I am not going to do this now. So you have to select stock A and stock C. So you're supposed to invest 60% of your wealth on stock A, 40% stock C. So construct portfolio, calculate portfolio expected return and portfolio risk. So before coming to this number, now you have to do a lot of things. We have discussed everything now. So you have to calculate what are the things that you have to do. You have to calculate expected return A. This is probability distribution is there. This is the probabilities. Those are the probabilities. So this is the probability distribution stock A, and for the stock C, treasury bill, market portfolio, all are the economy is same. This is the economic situation. So if the burst situation is occurred, this is the forecasted return for the stock A. If there is a boom, this is a forecasted return for the stock A. So likewise, you can see there is a distribution. So the total of this is equal to 1. You can check it. Now what you have to do, first you have to calculate expected return A. In the exam, you might get a question like this. Then you have to calculate expected return C. So you know how to calculate. Then you have to calculate standard deviation stock A, standard deviation stock C. And then next you have to calculate what? Covariance. In order to calculate portfolio risk, you should know covariance or correlation coefficient. So to calculate the correlation coefficient, first you have to calculate the covariance. So calculate covariance. So I'm writing here steps, so later you can do. I hope that you are you have confidence to do this by yourself, right? So you have to calculate expected return A, expected return C, then standard deviation A, standard deviation C, covariance A and C. Then you can calculate correlation A and C. Then calculate expected return portfolio and standard deviation portfolio. So calculate portfolio expected return and portfolio risk calculate karanda. So do as a homework, right? Do as a homework. Right. So now, so far we discussed that constructing portfolio with the two stocks. But in the really, if you go to the market, if you look at the market portfolio, now in Sri Lankan context, it includes 298 around stocks. But if you go to if you look at the US, developed countries, their market portfolio includes 3,000, 5,000 stocks. Yes, I will check the accuracy once you finish. I will give you my email address. So I will you can mail your answer. So I will mark 1 and I will give the answer. So then you can share. That way I will give the answers and the feedback. Right. So we are moving to the next discussion, right? Normally when it's come to the market, this is not around the two stocks. There are number of stocks in if you look at them, what you call that, MX or the American Stock Exchange. So like market, they have 3,000, 5,000 stocks. In Sri Lanka, that is around 298. When more and more securities are included in a portfolio, now we considered only the two stocks portfolio, but really as an investor, you always trying to diversify portfolio by adding more and more stocks. In theoretically, at least to have a well diversified portfolio, you should have at least 40 stocks in your portfolio. It's kind of a rule of thumb. But anyway, There are more than that to have a diversified portfolio. So when more and more securities are included in a portfolio, the risk of individual securities in the portfolio is reduced. But the risk represented by the covariance remains. So this is very important statement, but the risk represented by the covariance is remain. So when you include many number of stocks in your portfolio, individual stock or the securities risk is reducing. It is declining, but even though individual stock risk is reduced, but the risk related to the covariance, risk represented by the covariance between different stocks remains. So therefore, total risk of individual security is the variance of its returns. Now, as you measured so far, normally total risk you are measured using the variance or standard deviation, right? Total risk consists systematic risk as well as unsystematic risk. So when the number of stocks are increasing in the portfolio, total risk is declining, right? Total risk is declining, but that risk remains with the co-movements or the covariance, it remains. So therefore, now we will explain later with the diagram also. Total risk of individual securities, as you discussed so far, we measured using the standard deviation and variance. But remember, when we say the total risk, it includes systematic risk and unsystematic risk. Systematic, sometimes we term as the market risk. Unsystematic risk we term as the firm specific risk, and also diversifiable risk. Systematic risk is the undiversifiable risk. So what is systematic risk or what is market risk? It is the risk arise from say whole economic, with the whole economic conditions, with the uncertainties in the economy, and the tendency of individual security to move together with the changes in the market. So it is the risk arise to the investors that because of the changes in the government and the changes in the interest rate policies, corporate tax rate, inflation, foreign exchange. Apart from that, you can see tsunami, earthquake, and some kind of plot. So likewise, certain natural disasters also would affect to the all investors equally. So that risk you cannot diversify it away. This part of risk cannot be reduced through the diversification. It is we known as always, it is known as a market risk also. All the investors in the market are exposed to this risk evenly. Anybody cannot diversify. So some example I have put here, arising because of these reasons. Because of this reason, even with this power failure, we are exposed into some systematic risk. We cannot diversify. There are certain strategies are there. With that, I think you can see markets is down. Markets is going very worse situation. So with the market risk, with the changes in this political situation and the government issues, foreign currency issues, this kind of a risk in the environment. So they are all the investors are affected equally. So this is systematic risk. Investors are exposed to the market risk even when they hold the well-diversified portfolio of securities, right? Even though you have a well-diversified portfolio, still you are affected with the systematic risk. I have my portfolio with the 50 stocks in the market, but even I am affected with the changes in the interest rate, changes in the inflation, changes in the government policy rates, exchange market risk. So therefore, this part of risk, that is, we cannot diversify it away. So then what is the unsystematic risk? It is we call firm specific risk, or we call diversifiable risk. So this is you can diversify it away by having a well-diversified portfolio. Unsystematic risk arise from unique uncertainties of individual securities. Now, say for the example, company workers declare strike. Some particular public limited companies say they have declared strike. There is a very unrest in the employees, union action. So that part of risk, as an investor, you can avoid. You can invest in another company. You can invest in a company where negatively related with this particular company. So likewise, this firm specific reasons that risk arise because of this firm specific reasons, you can avoid. You can manage, you can eliminate. Research and development expert leave the company. So when the R&D head or R&D expertise leave the company, that is affected with the that company's future decisions. So that is in long term, that company's market price will goes down. So once these kind of things are happening in the company, you will get that information. So you will you can go away from that company to avoid the possible risk. So that part of risk you can manage as an investor. Competitors entered into the market. When a competitor enter, you can forecast what happens to your investment, what happens to your portfolio. So that is you can manage. Unable to obtain the adequate quantity of raw materials. So if a particular company cannot obtain the raw material adequately, so that company will face to the production issue, and then their turnover will decline. So their profits will decline. So attractiveness will decline. So ultimately in the market, their prices will go down. So when that things happen, you can go to the another stock. So you can diversify this risk with another company. So likewise, you can eliminate or you can diversify this kind of a firm specific risk. But the systematic risk that is coming from the macro level economy, that's affect to the all investors equally. So therefore anybody cannot avoid that. Anybody cannot diversify that. So therefore now it is clear, when we say the total risk, it includes systematic part and non-systematic part. So far, using the standard deviation and variance, you measured the total risk. So in this total risk, there is a systematic and unsystematic part. So now if you look at this diagram, you can see what I taught. Just look at this. Now here in the x-axis, this is number of stocks in the portfolio. This is portfolio risk. This is number of stocks. When the number of stocks are increasing, from 10 to 42, so likewise up to 2,000, 5,000, right? So what happens to this is total risk. So you can see this is total risk, portfolio total risk. So total risk is declining like this. Total risk is declining like this, but it's come to this point and it's not decline from this point. This is where the market risk. This is where the systematic risk. So total risk declining up to certain point. So we call this is minimum attainable risk in a portfolio of average stock. So it's declining. Totally unsystematic risk is declining, but this market risk or the systematic risk, this part is not diversifying. So it's not declining. So therefore, as an investor, as a logical investor, you should compensate something for this unsystematic risk. I think you remember that when I start this lecture, I told you that normally our required rate of return is equal risk-free rate of return plus risk premium. Normally our as an investor, my required rate of return is equal, risk-free rate plus risk premium. So this risk-free rate of return for the time difference, you have some benefit. This risk premium is for the risk. So now what is the relevant risk? What is the relevant risk? Is not the total risk, is not the unsystematic risk. Now relevant risk is systematic risk or market risk. So therefore, investor should compensate, should give some premium, should have something for bearing this systematic risk, for bearing this market risk. So normally, you know that current market interest rate is say around 7%. So this is our current required rate of return, prevailing rate. So this required rate of return is constructed with the risk-free rate plus the risk premium. Don't ask me a question. Now we are on the negative side because now risk-free rate of return is very large than our required rate of return even in our economy, because we are in a crisis now. So therefore, these fundamentals go upside down now. So therefore, don't ask that question, right? Then ඔයාලට පේනවනේ අද risk free rate of return එකටත් වඩා අපේ normal interest rate එක අඩුයි. එතකොට මේක නම් සමීකරණේ fundamental මේක වෙන්නේ කොහොමද කියලා you would ask that question. That's definitely. But anyway, now we are in a crisis. So therefore, our fundamentals, our primary theories goes now up and down. So therefore, that's not happening. So that's our crisis actually. But anyway, now this risk premium we are paying to the for bearing systematic risk, for bearing market risk. So this is now the next beginning. So therefore, again, this is another elaboration of the same thing, right? Total risk or the company specific risk, diversifiable risk is declining like this, but the market risk remain constant even though number of stocks are increased in the portfolio. Up to 2,000, up to 5,000, up to what amount you increase, you are bearing market risk. You have to have something for the market risk. Right. So thus relevant risk is its contribution to the risk of a well-diversified portfolio. Now with that discussion, you would now understood now the relevant risk or the market risk or the systematic risk is its contribution to the risk of the well-diversified portfolio. Because that once you construct a well-diversified portfolio, remaining part is the risk related to the co-movement, related to the covariance, right? So in the total risk, this unsystematic part you can diversify away, but it that risk arise with the co-movements or correlation, it remains. It remains. So therefore, the relevant risk is now its contribution to the risk of the well-diversified portfolio. එතකොට stock එක අනිත් stocks වලට market risk එකට නැත්නම් well-diversified portfolio risk එකට දෙන contribution එක තමයි covariance එක correlation එක මත ඇතිවෙන quantity එක ඇතිවෙන risk එක තමයි relevant risk එක. It is much smaller than the standalone risk. Right, when you have a well-diversified portfolio, it's very small than the standalone risk. Standalone risk means that is individual stock risk not related to a portfolio. අපි risk එක measure කරනවා නම් individual stock එක without relating to the portfolio, we call that is as a standalone risk. නමුත් අපි දැන් මේ portfolio risk එක තමයි වැදගත් දේ. ඒතර portfolio එක risk එක දැන් portfolio එකක් කියලා කියන්නේ ගොඩක් stocks මේ විදිහට තියෙනවනේ portfolio එකේ there are so many stocks. එතකොට මේ stock එකේ risk එක කියලා කියන්නේ දැන් මේ stock එකේ risk එක කියලා කියන්නේ මේ stock එකෙන් portfolio එකේ risk එකට දෙන contribution එක. එතකොට මේක diversified portfolio එක තියෙනකොට unsystematic part එක diversified වෙනවා automaticallyම is a free lunch එක. So then that's going away. But anyway, this its contribution to the risk of the well-diversified portfolio, it remains as the risk, right? Different stocks have different degrees of the relevant risk. It is measured by the degree to which given stock tends to move up and down with the market portfolio. So we can measure it by the degree to which given stock tends to move with the up and down of the market portfolio. So now we are coming to the market portfolio. So now this systematic risk or unsystematic risk, you have to measure related to the market portfolio. What is market portfolio? Simply market portfolio means portfolio of all risky assets. So in Sri Lanka, there are stock market, Colombo Stock Exchange, that's our market portfolio. So we have to measure that particular stock's returns related to the market portfolio. For that, there should be some mechanism in order to identify the systematic risk part. Then total risk එකෙන් unsystematic risk එක අපි ignore කරනවා. මොකද ඒකට ආයෝජකයෙකුට මොනවත් දෙන්න ඕනේ නැහැ. එයා rationally හොඳ diversified portfolio එකක් හදාගත්තාම unsystematic risk එක automatically going away. That is diversified away. So therefore, no need to have a premium or something for the unsystematic risk. But we have to pay something for the systematic risk, market risk, because he is bearing that risk. එතකොට අපි ඒක measure කරන්නේ කොහොමද? That particular stock එකක් well diversified portfolio එක තියෙනකොට ඒක අර portfolio එකේ risk එකට දෙන contribution එක. So therefore, it is measured by the degree to which a given stock tends to move up or down with the market portfolio. So now, normally proxy for the market portfolio is the Colombo Stock Exchange portfolio. Is the proxy. In Sri Lankan context, it is the proxy. If it is from the Indian context, it can be a Indian stock exchange. So likewise, we have a market portfolio. In our market portfolio, if you look at, there are certain sectors. Traditionally, it was 20 sectors, but now with the new classification, there are 150 something sectors. You go to the market and read the sectors. So this reflects our economy. That marketplace reflects our economy. So when the market, now you can see what happening this time, market is going down. All share price index එක drop වෙනවා කියලා කියන්නේ අපේ economy එක down. That's reflect our economy. So in order to control this, I think in these days there are some precautions. They are doing trading only for the 2 hours or something with the power cuts and the things. They are controlling like this collapsing of the market. Right, so this is our market portfolio. So now we have to measure the risk related to the market portfolio. In order to measure this, we should have a mechanism. What is the mechanism we have? We are now going to calculate a beta factor. Right? So just simply elaboration, the same thing what I told, investors try to maximize the expected return. Yes, that is the nature. You're always trying to maximize the return, but at a minimum risk. So therefore, you have constructed a portfolio. As an investor, you are constructing portfolio with the 2 objectives. Actually, I think I forget to tell that this theoretical part. We have 2 objectives. One is we call non-satiation. If you read the textbooks, you can see non-satiation. Other one is the risk aversion. Non-satiation means when you have 2 different investments with the same return and with the different risk level. So you will select the one with the least risk. So that nature we call as the non-satiation. And also risk aversion means if you have say this is kind of a thing, say you have 2 stocks, right? X and Y. 2 stocks to select. Expected return, say here 12%, here 15%, standard deviation say 13%, standard deviation here say here say standard deviation is 18%, standard deviation say 10%. Now if I ask you to select which stock, you may select the one with the highest expected return. No. Here same risk, right? Say risk is 10%. Both are having the same risk level. Now, if I ask the question which stocks you are selecting, you may select the Y. As a rational normal investor, you may select the Y because to a same level of risk, stock Y is getting a high expected return. So therefore, if you are selecting 12 or if you are selecting X, that is nonsense. It's not rational. So you may select the Y. So this nature, this behavior we call in theory, that is non-satiation. So other one is the risk aversion. Say you have 2 stocks like this, X and Y. Say expected return is 12%. Y also expected return is 12%. Both are having the same expected return. Say standard deviation here 15%, here 20%. Now which one you may select? Which one you may select? X or Y?
X, madam.
You may select the X. Here, yes, this is 20% now. So you may select the X because if the identical expected returns are there, so no point of going to the one with the highest risk as a logical normal investor, you may select the X because you are risk averse. So that nature we call risk averse. So by constructing portfolio, you are obtaining, you need to achieve these two objectives, non-satiation and the risk aversion. So they are conflicting each other. You can see now they are conflicting. So in order to achieve moderate level, both objectives, so you are going with the portfolio. Right? So thus it is very important to identify the highest expected return portfolio at a given level of standard deviation or risk, lower standard deviation portfolio at a given level of expected return. So this is related to these two objectives of the investor. The question is how we identify the optimal when there are large number of stocks are available. එතකොට දැන් අපේ ස්ටොක් මාකට් එක ගත්තොත් 298ක් තියෙනවා. එතකොට මේ 298න් අපි මේ හොඳම පෝර්ට්ෆෝලියෝ එක ඔප්ටිමල් පෝර්ට්ෆෝලියෝ එක හොයාගන්නේ කොහොමද? අපේ මේ ඔබ්ජෙක්ටිව් දෙක ඇචීව් වෙන යම් ප්‍රමාණයකට දෙන ලද රිස්ක් එකකට වැඩිම එක්ස්පෙක්ටඩ් රිටර්න් එකක් සහ මේ දෙන ලද අපේ කියන්නේ වැඩිම එක්ස්පෙක්ටඩ් රිටර්න් එකට අඩුම රිස්ක් එකක් තියෙනවා. එතකොට මේ ඔබ්ජෙක්ටිව්ස් දෙක කොන්ෆ්ලික්ට්. අපි කොහොමද සිලෙක්ට් කරගන්නේ? So now we are discuss that investment opportunity set, or we call that efficient set. Actually, we are moving to the bit advanced area since you are a general level, since you are not specialized in finance field. But anyway, I will tell the story. You may understand. If you have some difficulty to get the things, don't worry. But anyway, this is what, if you are specializing in finance in future, you will learn this portfolio theory, capital market assess, pricing theory, capital market, security market lines. So those things we will discuss. But anyway, just to understand the reality, I have to explain this part also before finishing. Now, when there is a large number of stocks in the market, so how you select the one with highest expected return at a given level of standard deviation, ones with the lower standard deviation at a given level of expected return. Now you have a question, how to select that? So for that, there is a capital market theory. Now you can see two diagrams here. This is investment opportunity set, or the we call efficient set of portfolios with the stocks in the whole market. In our market, with that 298 stocks, with the stocks in the whole market, if you construct the different portfolios using expected return, now here you can see y-axis is the expected return, x standard deviation of the portfolio. If you construct different portfolios, as much as possible portfolios, you will end up with a shape like this. Expected return and standard. You make a theoretically even this efficient frontier you can draw using market portfolio, using the market information, right? In investment portfolio topic in future, you will draw this. Really, you will draw this using the Excel. So that with the large number of stocks or with the whole market, the feasible set looks like this figure. Feasible set of portfolios. Feasible set of portfolios look like the feasible set of portfolios represent all portfolios that can be constructed from a given stocks, given lot of stocks. Mean this one we sometimes term as the mean variance frontier, because here this is mean, this is variance actually. Standard deviation is square root of the variance. So this is sometimes in some textbooks it is termed as the mean variance frontier. So with the large number of stocks or with the whole market, you can identify the feasible set of portfolio. So feasible set of portfolios, if you draw, it should normally represent all portfolios that can be constructed given for it. This should be looks like this figure. This is what we discussed few minutes ago. This is with the two stocks. This diagram we have explained. So if you construct a portfolio only with the two stocks, this is the limits of diversification. This is the shape of the path of the diversification. But this is with the 3,000, 5,000, 200, 900 stocks. So this is the feasible set of portfolio. So in this feasible set of portfolio from here to here, we call that the efficient portfolio from here to here. Then අපිට identify කරගන්න ඕන මේකනේ අපේ objective එක highest expected return portfolio at a given level of risk or lowest risk portfolio at a given level of expected return. වැඩිම ප්‍රතිලාභයක් අඩුම risk එකකට ලැබෙන දෙන ලද risk එකකට නම් වැඩිම ප්‍රතිලාභයක් ලැබෙන portfolio. So therefore this is feasible set of portfolio. This is mean variance frontier. In this mean variance frontier, that portfolios from here to here, we identify as a efficient portfolio. The collection of efficient portfolio is called the efficient frontier, or we call efficient set. So efficient set that is indicated in this bold or the dark line. So and why we call the portfolios are efficient on this line? Because they are the portfolios that give highest return for a given amount of risk. Then අපි මේ point එක ගත්තොත්, if you take this point, if you take this point, මේ තියෙන්නේ මේකට අදාළ risk එක. මේ portfolio එකට අදාළ risk එක. ඒතර මේ දෙන ලද risk level එකට දැන් මේ හරියට portfolios තියෙනවා. හරි? මේ හැමතැනම portfolios තියෙනවා. They are not efficient part. ඇයි අපි ඒවා efficient නැහැ කියලා කියන්නේ? දැන් ඔයා මේ portfolio එක select කරගත්තොත් අපි හිතමු මේ risk එකටම මෙතන portfolio එකක් තියෙනවා. ඒතර if you selected this portfolio, your risk is this much, you have possibility to go up to this expected return. So you are end up with the inefficient portfolio. ඒතර මේ line එක මත තියෙන portfolios they are efficient. ඒතර මේ හරියට ඒ වගේ දැන් මේ මෙතන මේ line එක මේවා shape වෙනකොට මේ විදිහට මෙතනට එනවා. ඒතර මේ හරියට තියෙන portfolio එකක් ගත්තොත් ඇයි මේ risk level එකට ඔයාලට මෙතන portfolio එකක් තියෙනවනේ. So no point of stopping at this portfolio, so you can go to up to this portfolio. The highest return for a given amount of risk. Why we call this as the efficient portfolio? Because they are the portfolio that give highest return for a given level of risk. Clear? They are the portfolio that give the highest return at a given level of risk. And also they are the portfolio the lowest decrease of risk and any expected return. Either may expected return level එකට may expected return level එකට යන්න පුළුවන් minimum risk එක මෙතන තියෙනවා. The lowest degrees of risk that any expected return. So therefore from here to here we identify as the efficient frontier, or we call efficient set of portfolio. This is actually the feasible set. මේ සම්පූර්ණ මේ diagram එකෙන් පෙන්වන්නේ feasible set එක. ඒතර feasible set එකෙන් අපි rational invest එක විදිහට අපි identify කරගන්න ඕන මොනවද කාර්යක්ෂම portfolio, efficient portfolio. So efficient portfolios lie on this line from here to here. All the other portfolios which lie outside the efficient frontier, එතන මේ portfolios they are outside the efficient frontier, are inefficient portfolios. Inefficient portfolios have lower returns and higher risk. දැන් මෙතන ගත්තොත් එහෙම අපි මේ portfolio එක ගත්තොත් return එක මේ හරිය තියෙන්නේ. return එක අඩුයි. නමුත් මේ risk එක තියෙනවා. high risk එකක් තියෙනවා. ඒතර they are not efficient. So portfolios from P to R, P, B, C, D, R, they are efficient. They are the efficient portfolio. In a market situation, a large number of investors holding portfolios consisting now this is actually the without risk-free asset. This is considering only the risky asset. But in reality, you may invest in the risk-free asset also. This is capital market theory, right? I am explaining here that capital market theory. In the capital market, investors invest some part of his wealth on risky asset and also some part of his risk risk free asset. සාමාන්‍යයෙන් අපි risk free investment වලයි risky market portfolio එකේ invest කරනවා. So what is the question? A is not the efficient portfolio because you can see A කියන මෙන්න මේ risk level එකට දැන් මේ A කියන portfolio එකේ risk එක මෙතනනේ තියෙන්නේ. දැන් මේ තියෙන y axis එක risk line එකනේ. එතකොට ඒ risk level එකටම ඔයාට යන්න පුළුවන් මෙන්න මෙතනට යනකම්. මේ මෙතන තියෙන portfolio එක තමයි efficient portfolio. මොකද ඒ risk level එකට ඔයාට මෙතන ගියොත් මේ තමයි your expected return. එතකොට you are not efficient. You are not rational. So you have to select the portfolio in the efficient frontier. This is the efficient frontier from here to here. දැන් මේ කැලේ තමයි efficient portfolios තියෙන්නේ. එතකොට මේ risk එකට අපි හිතමු මෙතන risk එක 15යි කියලා. එතකොට 15ක් කියන risk එකට ඔයා මේ portfolio එකට යනකොට ඔයාට පුළුවන් මෙතන expected return එක ඊට වඩා වැඩි. මෙතන expected return එක 10යි නම් මෙතන expected return එක 20යි. So no point of investing in this portfolio. This is not risk efficient. And also Q also not efficient. There is a dominant portfolio in the efficient frontier. මේ portfolio එක dominate කරන portfolio එකක් efficient frontier එකේ තියෙනවා. එතකොට you have to select that one. You have to select that one. This is actually theoretical part, right? This is capital market theory, right? So in the capital market situation, large number of investors hold in portfolios consisting of risk-free assets and multiple risky securities. Normally, investors are investing risk-free investment as well as market portfolio. Risk-free asset, you know that they are the stocks or the investment that reflect default risk-free investment. Normally, government treasury bills and government bonds. We call as the risk-free investment because there is no default risk. Remember, don't have the default risk only, right? Default risk එකක් නැහැ. But market risk, political risk, foreign exchange risk, reinvestment risk, all are there. Only the default risk because the issuer is the government, no? දැන් government එක default වෙන්නේ නැහැ කියලා theoretically අපි believe කරනවා. නමුත් ඔයාලට practically පෙනේ government එක default වෙනවා කියලා. But anyway, theoretically that's accepted. Governments are not defaulted. So therefore we believe that there is no default risk. Risk-free assets securities has a zero variance or standard deviation. ඔයාලා එක දැක්ක අපේ example එකේ zero variance එකක් තියෙන risk-free investment වල variance එක නැහැ. Standard deviation එක zero. Government treasury bills or bonds are approximate example for risk-free security as they have no default risk. When risk-free and risky asset is combined, the portfolio return is this formula. Then you know how to calculate the portfolio return. When you combine market portfolio එකයි risk-free investment එකයි combine කරලා ඔයා portfolio එකක් හැදුවොත් එතන your portfolio expected return, risky security, its weight, expected return or the risk-free rate of return into its weight. පැහැදිලිනේ? බරිත සාමාන්‍යනේ එක stocks වල බරිත සාමාන්‍ය. මේ ඇවිල්ලා risky investment එකේ invest කරු බරිතේ, මේ ඇවිල්ලා risk free investment වල weight එක. So then you by getting the weighted average you will get the expected return. So then your efficient frontier looks like this. It goes like this. When you combine risk-free investment to the market portfolio, your efficient frontier goes from RF to M to Q. Normally in practical world, you are investing in the risk-free. එතකොට අපි market එකේම investment කරන්නේ නැහැනේ. market කියන්නේ risky portfolio එක. එතකොට මේ තියෙන market portfolio එක මෙතන you can see that is touching point, this straight line and මේ feasible set එක නැත්තම් මේ opportunities අපේ feasible set එක touch කරන point එක මේක තමයි market portfolio. එතකොට you can so given the risk free asset, an investor can create new portfolio that can combine risk free asset with a portfolio of risky asset. So you can create portfolios like the මේ lines මේ විදිහට යනවා. මේ විදිහට තව ඕනතරම් lines යනවා investor එයාගේ requirement එක අනුව. නමුත් efficient frontier එක වෙන්නේ දැන් මේ this one. උඩම තියෙන එක. This one. This is the efficient frontier. අපි මේකට කියනවා capital market line එක කියලා. This is efficient point. Even line shows the manner in which capital is allocated. This line is called capital allocation line, or we call capital market line. Portfolio M, this one. Portfolio M is the optimal risky portfolio. Is the optimal risky portfolio. එතකොට මේ හරියට risky portfolios තියෙනවා. මේ තමයි optimal risky portfolio which can be combined with risk free asset. එතකොට මේ portfolio එකයි optimal risky portfolio එකයි ඔයා risk free investment වල invest කරනවා නම් ඔයාගේ portfolio එක මේ හරිය තියෙන්නේ. ඒතර අපි හිතමු සමහර වෙලේට ඔයා risk free rate of return එකට borrow කරලා තියෙන ධනයටත් වැඩි ඔයා මාකට් පෝර්ට්ෆෝලියෝ එක ඉන්වෙස්ට් කරනවා නම් ඔයාගේ ඉන්වෙස්ට්මන්ට් එක එන්නේ මේ හරියට. Now next we explain this, then this is we call lending portfolio. From M to upward we call borrowing portfolio. Right? Portfolio M is the optimal risky portfolio which can be combined with the risk free asset. එතකොට optimal risky portfolio එකයි risk free investment වල invest කරනවා නම් ඔයාගේ portfolio weight එක මේ හරිය තියෙන්නේ up to M, RF to M. හැබැයි සමහර ආයෝජකයෙක් ඉන්න පුළුවන් he or she is very risky. He is risk taker. එයා risk එක ගන්න ඉතාම කැමති කෙනෙක්. ඒතකොට එයා මොකද කරන්නේ? risk free rate එකට borrow කරලා එයාගේ තියෙන wealth එකයි අර borrowing money ඔක්කොම invest කරනවා මේ market portfolio. එතකොට his portfolio will lie from M to Q. So this is we call borrowing portfolio. Up to RF to M we call lending portfolio. So I think that's explaining in the next slide. With the risk-free lending and borrowing, capital market line is follows RF to M. එතකොට මේ risk-free lending and borrowing එක capital market line එක දැන් එන්නේ RF to M to Z. දැන් මේ මෙතන without risk-free asset මේ තමයි capital market line එක. Efficient set එක. This is the capital market line. But with the risk-free lending and borrowing, now capital market line is goes like this. ඒතර risk-free වගේ මේ risk එක මෙතන බිඳුවයිනේ. මෙතන බිඳුවයිනේ. ඒතර risk-free වගේ මෙතන risk-free rate of return එක තමයි මෙතන එන්නේ. Right? I think you can understand. So then with the risk-free lending and borrowing, capital market line is as follows: RF M to Z. You can see that line. The tangency portfolio would be the market portfolio. So capital market line is an efficient set of risk-free and risky securities, and it shows the risk-return trade-off of in the market equilibrium. This is very important. So capital market line is reflect efficient set of risky portfolio as well as risk-free investment. දැන් මොකද අපි risk free investments උත් අපි borrow කරලා තියෙන්නේ. අපි invest කරලා තියෙන්නේ. I will explain lending portfolio again. දැන් මේ capital market line එක උඩ තියෙන portfolios ඔක්කොම efficient. They are efficient. ඒතර දැන් මේ capital market line එක straight line එකක් වෙනවා risk free investment introduce කරපු ගම. එතකොට මෙන්න මෙතන ඉඳන් මෙතනට අපි කියන lending portfolio M වල ඉඳන් Z වලට අපි කියන borrowing portfolio. I will explain it right with the example. So capital market line is an efficient set of risk-free and risky securities, and it shows risk-return trade-off in the market equilibrium. ඒතර මෙතන දැන් මේ market එකේ මෙන්න මේ portfolio එකට අදාළ වෙන risk එක තමයි මෙතන පෙන්නන්නේ. So this is market equilibrium. ඒ කියන්නේ market එකේ risk එකට අදාළ equilibrium price එක, equilibrium rate of return එක you can identify using capital market line. This is bit advanced theory, but anyway, I am explaining this is because of the master, you know. But for the undergraduate, that's up to the 2 asset portfolio diversification is enough. But anyway, you are doing master of MBA, master of business administration. So therefore, you should know at least this reality. These calculations I am not going to go deeply, but anyway, this you have to identify in practical world. So this is the capital market theory. So here, one of you asked that this is lending portfolio, RF to M. According to this analysis, the optimal portfolio of risky asset would be in the market portfolio. This is the market portfolio, right? Optimal portfolio of risky assets would be on the market portfolio. Portfolios from RF to M, from here to here, RF to M, we call as the lending portfolio. Why? investors lend a portion of their investment at risk-free, or that means buying risk-free investment. ඒ කියන්නේ එයාගේ ධනයෙන් කොටසක් risk-free investment වලත් invest කරනවා, buying risk-free securities. So therefore portfolio from RF to M lending portfolio. The portfolios from M to upward, මෙතන ඉඳන් මෙයාට, from M to upward, we call as the borrowing portfolio. Why? Because they borrow some money at RF. Then මෙතනදී මේ highly risk taking investors ලා, they borrow some money at RF, right? They borrow some money at RF and invest both their capital and borrowed money in the market portfolio. So they are highly risk takers. They expect high return as well as high risk. So that is we call borrowing portfolio. Depending on the risk preference, investors can choose either lending or borrowing portfolio. So that depends on the risk preference of the investors. If you are a risk averse investor, so you put some money on the risk free and balance in the risky market portfolio. If you are a risk taker, you would put your own money as well as the borrowed money on the risky market portfolio. So this is lending and borrowing portfolio. Is it clear? One of you have asked what is that lending and borrowing portfolio? Greek wageda? Are you okay? Do you have any questions, any clarifications up to this? Right. Okay. So then expected return and risk of lending and borrowing portfolio you can calculate using this formula. So expected return, as I shown you in the earlier, you can calculate weight on risk-free, rate of return on the risk-free investment plus weight on the optimal market portfolio into the market expected return. So that is the weighted average. So then when it's come to the risk, for the risk of the risk-free investment is zero, no? It is zero. So therefore, simply risk of the lending and borrowing portfolio is equal to the weight and risk of the market portfolio or the standard deviation of the market portfolio. Risk-free investment වල risk එක standard deviation එක variance එක බිඳුවයිනේ. එතකොට අවසාන වශයෙන් අපේ formula එක වෙන්නේ lending and borrowing portfolio වලක risk එක කියන්නේ market portfolio එකේ standard deviation එක වැඩි කරනවා ඒකේ බරිතෙන්. So that is equal to the weight on market into its standard deviation. Because there is no covariance, even the market and the treasury bills. Remember that? There is no covariance. They are not moving with the market, no. So therefore, even covariance is equal to the zero. So then once you apply this double summation equation with the risk-free rate and the market portfolio, you will end up with this part. Other අනිත් කැලේ ටික ඔක්කොම zero වෙනවා. Just I think you can remember this double summation equation. No, I will go to that one. Just simply elaborate. The මේ equation එකේ portfolio के return එකනේ අපි මේ ගන්නෙ. මේ equation එකේ මේක අපි හිතමුකෝ market portfolio එක කියලා. මේ ඇවිල්ලා risk free එක. ඒතර risk free එකේ මේක 0 නේ. ඒතර මේ කැලේ 0 වෙනවා. මෙතන correlation එකක් නැහැනේ market එකත් එක්ක. ඒකත් 0 වෙනවා. So අවසාන වශයෙන් lending and borrowing portfolio එකේ lending or borrowing portfolio එකේ risk එක කියලා කියන්නේ optimal risky portfolio එක වැඩි කිරීම its weight. That's how come it. Right? So then you can calculate risk of the lending or borrowing portfolio simply using this formula. Weight on the market portfolio is, this is important, right? Weight on the market portfolio is less than 1 for the lending portfolio. Less than 1 for the lending portfolio. By in case of the lending portfolio, you invest in both optimal market portfolio as well as the risk-free investment. But in borrowing portfolio, weight on the market portfolio greater than 1. Why greater than 1? Your own money as well as your borrowed money, both you are investing in the market portfolio. So therefore, it is greater than 1. So simply I will put the example here. Now look at this expected return and risk of lending and borrowing portfolio. So risk-free rate, assume 3%. Market return is given for the different probabilities. So you know that this risk-free rate is constant irrespective of the market happening. That's why we call that risk-free, no? So that is 3%. So then here you can see market RM mean market portfolio return. So this portfolio, you can see 50-50. 50-50 mean 50% of your wealth on the market portfolio, 50% of your wealth on the risk-free. So this is then what we call this portfolio. Is it a lending or borrowing portfolio? Which one is the lending portfolio? Now here, if you look at this way, this is minus 0.5 on the risk-free asset. Minus 0.5. It means that you are borrowing at the risk-free rate. Both borrowed money as well as your own wealth, you are investing in the market portfolio. So wait here for the risk-free minus 0.5, for the market 1.5. So this is lending portfolio. This is borrowing portfolio. So now you can calculate expected return. Simply expected return is the expected return of this portfolio. Simply, I think you can remember that. Now you can use the method that you can calculate. So expected return. You have to calculate expected return. Expected return risk-free. That is 3, no? Then calculate the expected return market. This is forecasted return, no? Expected return market means you can calculate 1 into 0.1 plus 0.2 into 0.9 with the probabilities, no? 0.2 into 0.9 plus 5.4 into 0.5. මේවා දැන් අපි කතා කරලා තියෙන්නේ 5 point plus 5.8 into 0.2. So this will give you the expected return market. So now calculate the weighted average. එහෙම නැත්නම් මෙතන මේ ඔයාලට දීලා තියෙනවා weight එක පදනම් කරගෙන ගණන් ටික හදලා තියෙනවා. මෙතන අර statistical method එකට ගන්නත් පුළුවන්. මේකෙන් 50%, මේකෙන් 50%. So that is equal to 2. 50% on 3 and 50% on the 0.9, 1.95. So likewise, then this you have to multiply by the probabilities. So then you will get the expected return, 3.57, 4.71. Either statistical method or that formula you can use. You know how to calculate expected return. That is weighted average. That is weighted average. So this is the expected return of the lending portfolio. This is the expected return of the borrowing portfolio. Now you can see in case of the borrowing portfolio, weight is greater than the 1. Here you can see the weight is greater than the 1.5 in the market portfolio. Here 50-50, 0.5 in the market portfolio. So I think now it is clear. Now, the slope of the capital market line describes the best price of a given level of risk equilibrium. So you can calculate slope. I think you know how to calculate slope here. Delta x divided by delta y. So likewise, simply you can calculate the portfolio slope, this line slope. So this slope of the capital market line, itra me line එක slope එක ගත්තොත් that gives you the best price of a given level of risk equilibrium. So you can calculate slope using this formula, expected return market. So you can see here, this is the market portfolio. So then expected return market here and risk-free rate. That is this difference. expected return market minus risk-free rate. Risk-free rate කියන මෙතන. Divide by this gap කියලා කියන්නේ that is market standard deviation. මොකද මෙතන බිඳුවයිනේ. Risk-free rate එකේ variance එක බිඳුවයි. So therefore simply you can get the standard deviation market. So using this formula, you can calculate slope, capital market line, slope of the capital market line. So once you know the slope, so slope of the capital market line gives you the best price of a given level of risk in equilibrium. Market වෙළඳපොළ market එකේ සමතුලිතයේදී දෙන ලද risk එකට අදාළ price එක තමයි මෙතන තියෙන්නේ. මේ මොන risk එකද දැන්? This is only the systematic risk. This is only the market risk. So if you calculate the slope here, this is simply the best price of a given level of risk at the equilibrium. So if once you know the equilibrium, you can use the capital market line to forecast the expected return of securities on efficient portfolio. Because on this capital market line, there are only the efficient portfolio. There are only the efficient portfolio. දැන් ඔයාලට මතකනේ capital market line එකට තියෙන්නේ efficient portfolios විතරයි. So then once you estimate the slope of the capital market line, so you can use that number to calculate the expected return on efficient portfolio on capital market line. So this is the formula. Expected return efficient portfolio. මතක තියාගන්න මෙතන relevant only for the efficient portfolio. On efficient portfolio, on SML, CML is equal RF plus slope into sigma P mean portfolio risk or the portfolio standard deviation, that relevant portfolio standard deviation. So this is the slope. This is the slope. Slope එක අපි වැඩි කරනවා ඒ අදාළ portfolio එකේ අදාළ efficient portfolio එකේ standard deviation එක. ඒතර මේ portfolio එකේ standard deviation එකේ දැන් පෙන්නන්නේ systematic risk එක විතරයි because it is a efficient portfolio. All the unsystematic risk is now diversified away. So therefore you can use this capital market line based forecasting, or you can use this capital market line to forecast expected return on CML. Simply right. Thus, CML specify the linear relationship between the efficient portfolio's expected return and risk. There is a linear relationship between the expected return and risk of the efficient portfolio. CML specify the linear relationship between the efficient portfolio's expected return and risk. In an efficient portfolio, all unsystematic risk is eliminated, and therefore its remaining risk is the market risk. In an efficient portfolio, all the unsystematic risk diversified, eliminated. So the remaining part is only the market risk. So therefore, unlike individual stock, the risk of an efficient portfolio you can measure by standard deviation. So in this standard deviation shows only the systematic part because this is an efficient portfolio. It is inefficient portfolio එක නම් අපිට ඒක ගන්න බෑ. මොකද inefficient portfolio එක unsystematic risk එකකුත් තියෙනවා. නමුත් now on this capital market line there is only the efficient portfolio. So once you calculate the standard deviation of the efficient portfolio, it is the market risk. It is the market risk. It is the systematic risk. So therefore we can use here standard deviation. You can use here standard deviation of the efficient portfolio. Simply use this number. Assume risk-free rate is 10%. Market forecasted return or the expected return is given 15% market return. And this is market risk. Sigma M. Sigma M means that is market risk is 15%. This is market return. This is market risk. The slope of the capital market line, using this formula, you can calculate. Slope of the capital market line, expected return market minus risk-free rate divided by market return. Sorry, market risk. Simply we use this formula, right? So this is expected return market expected return 15% minus risk-free rate divide by market risk 15%. This is the slope 0.33. So this is the best estimation for the best price for the given level of risk. This is the slope in the capital market line. That's only for the efficient portfolio. Now, in a particular efficient portfolio, you had assume standard deviation 12%. දැන් මේ capital market line එක උඩ තියෙන මොකක් හරි efficient portfolio එකක් එක lending portfolio එකක් වෙන්නත් පුළුවන් borrowing portfolio එකක් වෙන්නත් පුළුවන්. So you have calculated its standard deviation, say it is 12%. So then you can identify portfolio expected return simply slope into this efficient portfolio standard deviation plus risk-free rate using this formula. For the exam paper, if you are given the information related to the efficient portfolio based on the capital market line on say, CML, you can forecast the expected return using this linear relationship. So you will get it is 13.96%. So simply this is the application of the capital market line to calculate the expected return. Right. So now capital market line, I think now it is clear, gives the expected return standard deviation of efficient portfolio. Right? Capital market line give the expected return standard deviation relationship for the efficient portfolio. The problem is that it gives the expected return standard deviation of efficient portfolio. එතකොට මේ capital market line එකෙන් expected return standard deviation දෙන්නේ only for the efficient portfolio. So then expected return standard deviation of inefficient portfolio and also individual stocks are not given. එතකොට stocks මේ හරිය තියෙන portfolios. එතකොට ඒවා efficient නැහැ. They are not in the optimal portfolio. එතකොට අපි මේ වගේ කොහොමද expected return එක ගන්න? මේ හරිය individual stocks තියෙන්න පුළුවන්, portfolios තියෙන්න පුළුවන් market එකේ. So then how to calculate their expected return and standard deviation? So you can't forecast their expected return based on this capital market line. So problem with the capital market line, it includes only the efficient portfolio. It gives the expected return risk relationship only for the efficient portfolio. For that, there is a model we call capital asset pricing model. This is empirically well pronounced, well developed. Even Nobel Prizes won by this Sharpe and Lindner in some way in 60s, 70s. So this is very empirically very profound model that has developed to estimate the expected return for any stocks, expected return for any individual stocks as well as for the portfolio. Either efficient portfolio or non-efficient portfolio, you can apply the cap rate to calculate the expected return. So now we are moving to that discussion. What is the cap rate? When every investor holds the market portfolio, they bear the systematic risk. That point is clear. Then hammer තාර්කික ආයෝජකයෙන් දැන් අපි මේ world එක කතා කරන්නේ efficient world එක. ඒතර මේකේ හැමෝටම සාධාරණ විදිහට information හම්බ වෙනවා. හැම ආයෝජකයෙම උත්සාහ කරන්නේ optimal portfolio එකේ invest කරන්න. ඒතර ඒ අනුව හැමෝගෙම උත්සාහය demand කරන්නේ ඒක වෙනකොට that will become the market portfolio. ඒතර ඒ විදිහට තමයි අපි ඒකට market portfolio කියලා කියන්නේ. ඒතර හැමෝම if every investor hold the market portfolio, right, this is the equilibrium portfolio. So all the investors bear only the systematic risk. Thus, the required return for any asset should be a function of the systematic risk or the beta risk. දැන් මේක පැහැදිලිනේ. දැන් එතකොට මම අර මුලින්ම හැම වෙලේම කියපු equation එක. So the required rate of return for any asset or portfolio or for any asset should be a function of systematic risk. Function of beta risk. Now you are facing with the new term because systematic risk we are measuring using beta. So that some textbooks it says that the beta risk, market risk, systematic risk, all we are using interchangeably, right? So the required return for any asset should be a function of this systematic risk. The relevant risk of an individual stock is measured by the beta coefficient. Either efficient portfolio or the inefficient portfolio for the individual stocks in the portfolio. So you can measure the risk. That's relevant risk is the market risk, beta risk, or the systematic risk. So you can measure it by calculating beta coefficient. Beta coefficient. So beta coefficient is very important, that CAPM world is developed with the beta. So beta is defined under the CAPM. It is the amount of risk that the stock contributes to the market portfolio. That is that covariance. That's the risk remains with the covariance. Then market portfolio ke tiyena stock ekak market portfolio ke risk eකට contribute කරන ප්‍රමාණය. ඒ කියන්නේ ඒ ටික diversify කරන්න බෑ. So that beta measures that one. Very logical. The amount of risk that the stock contributes to the market portfolio or the well diversified portfolio. Market portfolio කියන්නේ well diversified portfolio එකට තියෙන proxy එක. The capital asset pricing or we call CAPM is a model that provides required rate of return and risk. Beta risk relationship of all assets when they are held in the well-diversified portfolio. So this CAPM has developed a model. It shows the relationship between the required rate of return and the systematic risk or the beta risk when that particular stock is held in a well-diversified portfolio, in a market portfolio, or in a well-diversified portfolio. Or either this portfolio efficient or not is not a matter. අපිට මේ මොඩල් එක පාවිච්චි කරලා expected return එක ගන්න පුළුවන් that portfolio should not require to be efficient. Require rate of return, risk of relationship of the all assets when they are held in the well diversified portfolio, either efficient or not. Under the CAPM, we develop a line we call security market line. Then our capital market line එක මෙතනට එනකොට security market line exemplifies the relationship between assets risk and its required rate of return. Right, so then this is the CAPM model. So required rate of return for any asset in an efficient or inefficient portfolio is equal risk-free rate plus risk premium. So this risk premium we measure using the beta. So beta, how we measure the beta? Beta is covariance stock I with the market portfolio divided by variance of the market portfolio. අපි මේ බීටා එක මෙෂර් කරන්නේ කොහොමද? මේ සමීකරණය. මේ I කියන ස්ටොක් එක මාකට් පෝර්ට්ෆෝලියෝ එකත් එක්ක තියෙන සහවිචලතාවය. ඒතර මාකට් පෝර්ට්ෆෝලියෝ කියලා කියන්නේ well diversified portfolio එක. ඒතර ඒකට මේක දක්වන සම්බන්ධතාවය. මේකට කොච්චර ඒ කියන්නේ මේ ස්ටොක් එකෙන් ඒ පෝර්ට්ෆෝලියෝ එකේ රිස්ක් එකට දෙන contribution එක, covariance එක. අපි ඒක බෙදනවා variance of the market. Variance of the market. So that will give you the beta of the stock I. The security market line shows this relationship in the CAPM. So using this formula, you can estimate required rate of return for any asset in a diversified portfolio, either efficient or not. So the beta you can estimate using this. If you go to the stock market, for the all 298 stocks, beta is there. While on stock market website downloading areas under අපිට බීටා එක මේ ඩවුන්ලෝඩ් කරගන්න පුළුවන් අපේ කම්පැනිස් වල බීටා එක. ඒතර මේ බීටා එකෙන් පෙන්වන්නේ මේ අපි හිතමු සම්පත් බැංකුවේ බීටා එක කියලා. ඒතර මේ බීටා එකෙන් පෙන්වන්නේ මේ කම්පැනි එකේ මේ ස්ටොක් එක නැත්නම් මේ කම්පැනි එකේ සිස්ටමැටික් රිස්ක් එක. ඒතර මාකට් පෝර්ට්ෆෝලියෝ එකට සාපේක්ෂව තමයි මේ බීටා එක අපි ඩිෆයින් කරන්නේ compared to the market portfolio. If beta is greater than 1, that company risk is more than the market risk. If beta is less than 1, market risk eකට වඩා ඒක අඩුයි. So I will define this terms later. So likewise you can measure the systematic risk. So this is simple formula. So now this is security market line. So security market line gives the required rate of return and risk relationship for all assets, either efficient or not. So based on that, you can calculate required rate of return for any asset. Individual stocks require rate of return is equal to the risk-free rate plus risk premium. Risk-free rate plus risk premium. So this is lending portfolio, they are the borrowing portfolio, either efficient or not. For any asset, you can apply this CAPM model. This is empirical developed model. So even today, for calculation of the required rate of return, for the calculation of the cost of capital, in the practically investor analyst, they are using this model. They are using this model. Right. So the stocks beta coefficient for stock I, as I told you, you can calculate like this. So covariance stock I with the market divided by the variance of the market. So since the stocks beta measures its contribution to the risk of a portfolio, beta is the correct measure of the stocks risk. So now you can see how we calculate beta. Beta measures its contribution to the risk of the portfolio, either efficient portfolio or inefficient portfolio. So beta is the correct measure of stocks risk. In addition to measuring the stock's contribution of risk to a portfolio, beta also measures the stock's volatility relative to the market. So once you look at the beta, you can identify its relativity, how volatile that particular stock related to the market. So again, it is the risk. Again, it is the risk. Volatility means that is risk. Right? So now how to interpret the beta? How to interpret the beta? If beta is 0.5, stock is only half as risky as the market. Normally, market portfolio beta is equal to 1. Right? It is theoretically, normally market portfolio ke beta ekai. Is always it is equal to 1. So we interpret our stocks beta relative to that market portfolio. So when the beta is 0.5, it means that that particular stock has only a half as risky as the market portfolio. If held in the diversified portfolio. එතකොට මේ අපි හිතමු දැන් අපි company එක beta එක 0.5. එතන කොහොමද අපි මේක interpret කරන්නේ? මොකද්ද මේකෙන් කියන්නේ? 0.5 කියලා කියන්නේ market portfolio එකේ risk එකට risk එකේ ප්‍රමාණයට මේකේ risk එක භාගයකට සමාන වෙන්නේ. ඒ කියන්නේ තව විදියකින් කියනවා නම් අපිට මේක interpret කරන්න පුළුවන් market return එක 100ට අපි හිතමු 10%කින් වැඩි වෙනකොට මේ stock එකේ return එක වැඩි වෙන්නේ 105කින්. So that is the meaning. ඒතර market එකේ return එක 120කින් වැඩි වුණ වෙලාවක මේ අපේ company එකේ stock එක return එක වැඩි වෙන්නේ 110කින්. So half as risky as the market. So beta can be negative even, right? If it is negative, so it goes to the opposite direction. But anyway, that negative betas are very rare. මොකද සාමාන්‍යයෙන් අපි මාකට් එක කියලා කියන්නේ ඉකොනොමි එක. ඒතර මාකට් එක අප් වෙනකොට සාමාන්‍යයෙන් ස්ටොක්ස් වල රිටර්න්ස් උත් වැඩි වෙන්න ඕන. ඒක තමයි normal economy එක, normal තත්ත්වය. නමුත් negative betas also positive. Negative betas also possible. Right? If it is 1, if beta is 1, so that means stock is risky as the market. If held in a diversified port, අපි මේ stock එක ගත්තොත් මේකේ risk එක market එකට සමානයි. ඒ කියන්නේ market return එක 10%ක් වැඩි වෙනකොට මේකේ 10%ක් වැඩි වෙනවා. market return එක 10%ක් අඩු වෙනකොට මේකේ 10%කින් අඩු වෙනවා. So that is equal to market. If it is greater than 1, stock is more riskier than the market. If it is greater than 1, it is more riskier than the market. If it is less than 1, it is less riskier than the market. ඒතර risk එක market එකට වඩා අඩුයි කියලා කියන්නේ market එකේ return එක 10කින් අඩු වෙනකොට ඊට වඩා අඩු ප්‍රමාණයකින් තමයි මේකේ return එක වැඩි වෙන්නේ. If it is 0, am I audible to you? Because I experience a power failure.
Yes, ma'am.
Okay. So if it is 0, stock returns is uncorrelated with the market. You can't interpret. Beta එක 0 වෙන්නත් පුළුවන්. beta එක 0 වෙලා තියෙනවා කියන්නේ so you can't interpret that stocks systematic risk related to the market. Uncorrelated. So once the market return goes up, we can't say what happens to this particular stock. If it is 2, it is risky twice as market. Market return එක 10% වැඩි වෙනකොට ඒ වගේ දෙගුණකින් මේ stock එකේ return එක වැඩි වෙනවා. So likewise now this beta is a good measure. It measure its contribution to the risk of a portfolio related to the market portfolio. So this is shows the volatility even with the market. So you see how the measure is? මේ බලන්න එක measure කරන covariance stock I and the market portfolio එකත් එක්ක තියෙන covariance එක. ඒක බෙදනවා variance of the market. Right. Can the stock have negative beta? Yes, we can. But anyway, that is very rare. Negative betas are rare, but they can occur. Now, normally, for example, some stocks associated with the gold, such as mining operations, occasionally have a negative beta. I can market එක යන පැත්තට opposite ගමන් කරන්න. එතකොට එහෙම අවස්ථාවක් තියෙනවා. එතකොට මාකට් එක වැඩි වෙනකොට මේක අඩු වෙනවා. ඒ කියන්නේ සබ්ස්ටිටියුට් එකක් වාගේ තියෙනකොට gold investment එක වාගේ එහෙම වෙන්න පුළුවන්. But it's some rare situation. Meaning stocks return tend to move in the opposite direction of the market returns. Right? එතකොට ඒකත් possible. නමුත් it is very rare. Right. So now calculating beta in practice. එතකොට දැන් මේ beta කියලා කියන්නේ covariance market එකත් එක්ක තියෙන covariance එක. So in practically, empirically, if you are doing research in the future, you have to estimate the beta. So beta you can estimate very simply using regression. Market return, you have to regress on the stock return. So once you regress the market return on the stock returns, that slope is the beta. Many analysts use the standard and poor 500 in the USA or share price in the Sri Lanka as the market return. Then all research කරන්න එනකොට ඔයාලට මේවා practically proxies ගන්න වෙනවා. ඒතකොට so the proxy for the market return is all share price index. Then analysts typically use the 4 or 5 years monthly returns to establish the regression line. So sometimes you can use 52 weeks or few years. So you can use the regression line. So empirically you can estimate beta using this regression line. It is the slope of the regression line. Returns on the stock in regression on the Y, and the returns on the market. This is the market return. This is the stock return. So once you regress the market return on the stock returns, that slope of the line is the beta. Slope of the line is the beta. Slope of the regression line, which measures the relative volatility, is defined as the stock beta. So empirically, you can estimate using regression also. You can use this formula as well as you can use the regression. Empirical data again, so you have to run this regression to estimate the beta. So I have put some example here. This is market return. This is the JK securities return, right? For the 10 years I have taken. So I have run the regression like this. You can see the slope here. It is 0.83. Another, this is Excel output. So the slope of the regression is 0.83. So that is the beta. Shall we have a break? Because actually, in my area now it's power. I don't know. I thought that there is no power cut today, so
Yes, madam.